Imagine waking up in retirement, sipping your coffee while watching the waves crash into shore. You open your phone to check the time, but there's something else waiting for you first. A notification that pops up from your investment account. And it's not just any notification, it's a dividend alert. Your shares have just paid out. Every single month, this could be your reality. And today, we're diving into exactly how to make it happen. In today's video, we're going over exactly how to invest in dividend-paying stocks so you can get paid to exist. We'll explore what dividend-paying stocks are, how to analyze them, and most importantly, which ones are the most reliable. Stick around. By the end of this video, you'll know exactly how to pick stocks that will pay you indefinitely, even throughout retirement. Hey everyone, it's your friend and resident Wall Street, Curly, here to help you master your money and multiply your wealth. Let's get started. Step No. 1. What is a dividend stock? Even though the concept of dividend-paying stocks sounds complicated, it's actually pretty simple. When a company makes a profit, it has three options on how to use that money. They can keep it in reserve, invest it back into the business, or share it with the owners through dividends. That's where dividend stocks come into play. A dividend stock is simply a share of ownership in a company that pays you a portion of its profits. Most companies distribute these profits every quarter. This means you receive payment 4 times a year. Now, before you jump into picking stocks based solely on their dividends, let's take a closer look at the actual mechanics. A dividend is essentially a reward for being a shareholder, meaning you get rewarded for owning a piece of a company. To illustrate this further, let's imagine there's a lemonade stand that's making $1,000 in profit each year. If it pays a 5% dividend yield and 100 shares are outstanding, each share would receive a dividend of $50. So if you own 100% of the company, you'd get $50 as a dividend. Or if you own 10 shares, you'd get $5 in dividends. Now, in the world of finance, instead of saying that the lemonade stand is paying a 5% dividend yield, we say that each share is yielding 5%. This means that for every $100 you invest in a stock, you'd expect to receive $5 in dividends every year. However, it's important to remember that the exact amount of your dividend depends on the price of the stock. For example, if a share of the stock is trading at $100, you'd receive $5 in dividends per share. But if the same stock drops to $50, you'd still get the $5 in dividends. So if you buy more shares at $50 each, you'll receive a larger total dividend payout. Okay, so you understand the basics. Now let's move on to the main question. Why should you consider dividend-paying stocks? Well, there are a few compelling reasons. First, it's passive income. As a shareholder, you earn money without having to actively do anything. Second, dividends are often increased over time. Third, some companies, especially those focused on utilities or consumer staples, have a history of paying dividends that span decades. And lastly, studies have shown that stocks with a history of paying dividends tend to perform better during market downturns. Now that you understand the benefits, let's dive into the crucial aspect of choosing the right dividend-paying stocks. Step No. 2. 3 traits of a forever dividend stock. Picking the best dividend stocks isn't just about finding high yields. You need stocks that can sustain their payouts. That's where the 3 traits of a reliable dividend stock come into play. Number 1. Dividend growth history. The first thing I look for is a history of increasing dividends. It's a clear sign of a financially healthy company. But how can you identify such companies? Look for companies that have been increasing their dividends for at least 5 years. An even better option would be to find those that have increased their dividends for 25 years or more. These are called Dividend Aristocrats. The S&P 500 Dividend Aristocrats Index includes companies that have followed this strict rule. These companies understand the importance of rewarding shareholders. And by doing so consistently, they demonstrate their financial stability and commitment to value creation for shareholders. Number 2. Safe payout ratio. Next, I look for companies with a low payout ratio. This refers to the percentage of profits a company pays out as dividends. To calculate the payout ratio, you can use this formula, multiplied by 100. A payout ratio of 60% or less is usually considered safe and sustainable. Companies that maintain a lower payout ratio have more flexibility to reinvest in their growth while still rewarding shareholders. Number 3. Consistent earnings and cash flow. Finally, I focus on companies with consistent earnings and positive cash flow. Dividend payments depend heavily on a company's ability to generate profit, and cash flow is essential to ensure that profit. Look for companies with consistent earnings and cash flow over a period of at least 5 years. If a company has volatile or declining profits, it might struggle to maintain its dividend payments, especially during economic downturns. Step number 3. Dividend Aristocrats v. High-yield traps. When searching for reliable dividend stocks, you've probably come across 2 distinct categories: Dividend Aristocrats and high-yield traps. Dividend Aristocrats are established companies with a history of increasing dividend payments every year. They often operate in stable industries and have a solid track record of profitability and growth. Coca-Cola and Procter & Gamble are perfect examples. They've been paying and raising dividends for over 50 years. On the other hand, high-yield traps offer dividend yields that seem too good to be true, often between 10 to 15%. While they may attract investors seeking high returns, these companies might not have a proven history of dividend growth and sustainability. Many of these high-yielding stocks are from the energy sector, and they tend to be cyclical, meaning their earnings and stock prices tend to follow broader economic cycles. While they can be tempting, it's crucial to conduct thorough research before investing. Always dig deeper beyond the initial numbers to assess a company's financial health and future prospects. Step number 4. How to analyze a dividend stock's safety. Now that you know the key traits of a strong dividend stock, let's walk through a simple way to analyze a company's dividend safety. First, start with the basics. Find the company's payout ratio by dividing the annual dividend per share by the earnings per share. A payout ratio of 60% or below is generally safe. Next, review the company's earnings stability. Look for companies that have maintained or grown their earnings per share over the past 5 years. This indicates a consistent ability to generate profits. Next, examine the company's cash flow. Ensure that the company generates enough cash to cover its dividend payments. You can find this information in the company's cash flow statement. Also, check for a history of dividend growth. Look for companies that have been increasing their dividends for at least 5 years. This suggests a commitment to rewarding shareholders and a belief in the sustainability of their dividend payments. Lastly, evaluate the company's debt levels. High levels of debt can put a strain on a company's finances and its ability to pay dividends. Calculate the debt-to-equity ratio to assess the company's debt burden. A ratio below 1.0 is generally considered healthy. Step number 5. Real examples. Stocks that have paid for decades. Let's dive into some well-known companies that have a history of paying dividends consistently. Johnson & Johnson. Johnson & Johnson is a pharmaceutical and healthcare products company that has been paying dividends since 1944. It's increased its dividend for more than 60 consecutive years. Its average dividend yield over the past 10 years has been around 3%, just slightly higher than the S&P 500's average. Coca-Cola. Coca-Cola is a beverage company that has been paying dividends since 1920. It's increased its dividend for 61 straight years. Coca-Cola is known for its strong brand recognition and global presence, which contribute to its consistent performance. Realty Income. Realty Income is a real estate investment trust that specializes in commercial real estate. It's paid dividends for more than 50 years and has a reputation for providing monthly dividends. Its average dividend yield over the past 10 years has been around 4%. PepsiCo. PepsiCo is a beverage and snack food company that has been paying dividends since 1948. It's increased its dividend for over 50 consecutive years. PepsiCo's diverse product portfolio and strong brand names contribute to its reliability as a dividend payer. Step number 6. How to build your own dividend watch list. Creating a watch list is essential to stay organized and consistent with your dividend investing strategy. Here's how you can build one. Start by creating a spreadsheet or using a note-taking app. Include columns for company name and ticker symbol, dividend yield, 5-year dividend growth, payout ratio, and sector. Then research and fill in the details for each company on your list. This way, you can easily compare and track your potential investments. And finally, update your watch list regularly. Revisit your list at least once a quarter to ensure that the companies you're tracking are still meeting your investment criteria. Step number 7. What to avoid when building a dividend portfolio. When building a dividend portfolio, it's important to avoid common mistakes that can jeopardize your investment strategy. First, avoid chasing the highest yield. Focusing solely on the highest dividend yield can lead to investing in companies that prioritize dividends over reinvesting in the business. Instead, balance high yields with factors like growth potential and financial stability. Second, avoid over-concentrating in one sector. While it's okay to have exposure to various sectors, over-concentrating in one area like REITs or energy can make your portfolio vulnerable to industry-specific risks. Diversify across multiple sectors to mitigate risk. Third, avoid companies with erratic earnings. Prioritize companies with a history of stable and consistent earnings. Companies with unpredictable profits might not have the financial stability to maintain dividend payments, especially during market downturns. Now that you know how to pick stocks that pay you forever, it's time to apply this knowledge. Dive into our website for more resources to help you build your portfolio. And don't forget to subscribe to our channel for more helpful videos.